rep this? And how can I get better at this outside of the moment when it's not the pressure and the nuances and moving so fast? And maybe you start rewatching these things in half speed and you're like, wait a second, this isn't so scary. Okay, that's the big flush. That's what the box and the tape looked like. That's the turn. This is it starting to get more stable. And without the emotions involved, you process so much more accurately. And then when you get so many more reps, when it actually happens, look, I'm not going to say you're 0% scared. We're still human. You're always going to feel that. There's always going to be that uncertainty, but you're infinitely more prepared, and that helps pan out.
For sure. Reps are definitely the key. And I think this is something like at Trillium, you were the beneficiary and I was the beneficiary of, we have some of the greatest technology. Like we have a tool called Trader Rerun, which allows us to go and watch a play and watch the level 2 quote box and all the, time and sales as they happened, and watch that as many times as we would want. And, you can really gain a lot from that. But I think that the most, probably the step that some people miss is that you have to do the thought process to figure out what you're trying to accomplish first. Because if you can get 1,000 reps, but if you haven't taken the time to sort of figure out, the right way to do it and then rep it that way, then you could take, for example, if you're swinging a baseball bat and you just go up in there and you swing 1,000 times the wrong way, the only thing that you've done is make it even grained, even more deeply a bad habit. It's even now that, so ironically, you've put in all this work and you've made yourself worse off because you didn't first take the time to figure out, okay, what are the physics of swinging a baseball bat? What am I trying to do and how do I do it the most efficient way, and then repping that.
And you see this with trainees. So many people obsess over, I put X amount of hours of work in. I'd rather, obviously hours in work in general are good, but only if they're effective hours in work. If you swung the bat wrong 1,000 times, do you really want some congratulations? Do you think anyone's going to, in the training world, no one's going to pat you on the back. The market's not going to say, oh, hey, you're doing the same shitty swing 1,000 times. Good job. Here's some money. That's not how it works. And I see this with trainees. The most important thing is to make sure that the things you're working on matter. And I've seen this even over the years in Trillium. You'll have the person that relentlessly just studies the Seeking Alpha articles and the analyst reports and stuff. And it's like, okay, I'm not saying it's useless, but is it really all that effective? But then they're not able to take the right stop. They don't know what they're looking for. And so much of the process is, are you doing work that's maximally effective? Then obviously, if so, the more the better.
This is the trade that you sort of ascribe as the trade that saved your career. You were kind of out the door. You were, interviewing, and then this trade comes along, and this was your setup, and you went for it.
Yeah, and it's funny seeing. It's amazing, isn't it, that I was able to find all the execs in the chart. And when people talk about databasing and building these, I mean, this is that's 11 years ago now, and I was able to still find this in my notes and my records, and it just goes to show the level of work and the catalog. It's thousands and thousands and thousands of charts. And so this trade was special because on the daily, the daily chart, this was an exhaustion gap pattern. This was a pattern that I had studied quite a bit. It was something that we viewed as a higher probability pattern. And we had our little system of where to short, where to add. And while the executions on the chart might look a little chaotic, and this is what also I laugh about with the Twitter world, is everyone's like, oh my God, show me the execs, but you can't really see the size related to them, which obviously convolutes some of it. But the most important part was I had this system and this expectation of where this stock will end up, and it was something I had seen before. It is something I had built those reps in. This was much like that ARM trade we previously discussed. This was something that I was able to premeditate. We knew the stock was gapping up pre-market, and then we knew exactly at what prices we wanted it. We knew what we wanted to see. We knew we wanted to see this huge influx of volume get sucked in off the open, then a hard fail. And what happened? It shot up to about 97.50. The volume was super, super massive. That added to our conviction. Then as it starts to roll over, add. Then our target was this would kind of exhaust towards that Bollinger, and that's exactly what happened. And this trade, I think I made like 10,000 or 11,000 or so in it. But that was literally a career changing trade because that told me that I can do this. And I think my boss probably made 20x what I did, but I recognize that, wow, we did the same thing. If I can just build this skill set, that's life-changing money.
Sure. So I thought maybe quickly, I would run through just, as somebody who's learned from you, but who definitely trades differently. I'm a little bit more of a news trader. I would run through just one or two just quick, easy trades of my own. So this QLYS from February 6th, this had gone down a lot on the day before on an analyst note that they had lost a Microsoft contract. And then in the middle of the day, they put out a press release that they were rescheduling their earnings. And the read through that I had was, why would you reschedule your earnings with your stock down that much unless you had a pretty good response? And I was able to simply buy this, thinking that the market's going to think this is a positive development. They're going to have positive things to say. I don't think that I took a lot of risk, and I was able to scale it up just because this is some of the stuff that we worked on.
And to add some context to this, I would say you as a trader, this is in your wheelhouse, right? Your edge tends to be your speed, your precision in processing these headlines, your ability to sift through the noise versus what's relevant and know that context. How many traders out there were able to piece together so quickly, oh wait, this QLYS, this is the stock that was down, and I've seen this before. I have other examples where their desire to have their earnings report early, you connected those dots from pattern recognition and experience, and that speed gave you some of the best expected value in the market, right? If you can get some of those early prints, that is unbelievable. Because even if you're wrong, right, you can lose a couple points, but that ended up going over 10 points. And that's some amazing risk reward with very high probability.
Because I've seen, and I've cataloged this, that when companies have something negative to say, they tend to push that announcement out as long as they can. When they have positive things to say, they tend to push it up. That's just something I've noticed.
And it seems like an obvious, simple observation, but that's only obvious and simple with experience.
It's obvious and simple when you can sift that one data point out of sort of the ocean of data points. And I think that does come with experience. That's part of the, everybody gets better with experience.
Yeah, of course.
The other one I wanted to mention was this MOR. This is a biotech stock that was actually acquired. This was an M&A thing. And for anybody who's never, seen the way a buyout target or a company that's being acquired trades, it typically trades like a brick. It trades in a very, very narrow band because it's being acquired for a defined price. On this day, there was one of the most respected biotech analyst reporters on the street, Adam Feuerstein. He writes for the Stat News, came out and said he didn't think the deal was going to close for a variety of reasons, that there was a problem with the drug and that it wouldn't ultimately get FDA approval, and they didn't think that the deal was going to close. And to me, it wasn't whether I agree with them or not. It's to the point that there's this amazing analyst who's coming out, and this is his opinion. That's new information. And given that the risk is so limited because they're being acquired for a price just north of where we are now, the expected value on this is really, really good. Because if he's right,
your risk is so defined.
It's so defined. If he's right, the deal falls apart. So I was able to get short this really quickly, and putting that together, that okay, this isn't just like a random tweet. This is Adam Feuerstein putting out opinion on an M&A deal. Those are the type of things.
And even the context there, though, what percentage of the audience knows Adam Feuerstein? What percentage of the audience follows him? What percentage of the audience has all of his past market-moving tweets documented and has those analogies in their head like you did? And then you're taking, again, your edge with some of these headlines and knowing the context and being in the right spot and being able to apply that to wherever the relevant headline is.
I think that the most important thing is that in the past, I would have looked at something like that and been like, okay, this is obvious. Everyone's going to see this. And I would have shorted some. And some of our work together, it was that instinct is just complacency. And instead, I should realize that this is one of those easy trades that it's not as obvious as it might seem to me, and look at what the expected value is and take advantage of that. Every situation sort of has this, the situation and then the setup. They're two different things in my opinion. So you want to talk, for example, about like GME that's going on right now, where it's having another one of these, meme sort of explosions. So I think the situation is sort of that, the stock shouldn't be trading here on any fundamental basis. There's no reason for it. It's being, go back to 2020, for example. It was being bid up by an army of, meme people on Reddit. using money that they received from the government. It was more than 100% short. There were a whole bunch of structural reasons why this should be going up. So we have a situation where the stock should not be trading where it is. We know that, but the setup is terrible, right? Like, you never know where this is going to end. Like, it's probably the biggest short squeeze I've personally ever seen. And the thing that I took away from that was, when you have a setup where there's the situation and the setup and those two things are in conflict, the setup has to win. Because it's not about knowing that a stock should go somewhere. It's about how you prosecute that idea. That's where all the money comes from.
And I think the more common word for situation is almost having a view. And I think there's so many traders out there with views, but a view is worthless. And it's not about having a view. Where you really make money is when you have a view, plus the setup confirms that view, then you can capitalize on it, right? You might have the view that ARM is overvalued, or that ARM will go lower. If you're shorting on the way up at 110 and it blows out to 160, well, guess what? You blew up to it. It doesn't do anything. So what you really need is the view or the situation combined with the setup. And I think that's where so many people get themselves into trouble. And actually, that's one of the areas where I've seen you grow a lot. How many times have you had an interpretation of a headline? And there's times where you can be totally right, but you need the setup to confirm your view. And when that magic happens, when those see it moments, that's when you can really, really go for it. And that's, I think, what you've really corrected and made a lot of progress in.
Yeah, I think that's true. I guess the point I'm making, though, is that when you have sort of a great setup, even if the situation is not, something as obvious as GME, if you have a great setup, you probably have an easy trade, because you probably have a situation where your risk is defined, where if you're right, you're going to make a nice reward.
Because it always comes down to the math at the end of the day.
Sure.
The setup's everything.
Sure. By the way, for example, just in terms of expected value, I think that MOR trade, I would say that the chances of this deal probably blowing up were probably quite low. I don't think that those were very high, but the expected value was high because there was so little risk in putting that position on. So that's just a really good example of, you don't need to be right very often for that trade to have enormous expected value. In the context of expected value, we talked about identifying expected value and betting accordingly. Can you explain to me what you mean by betting accordingly?
Yep. So obviously, within your risk limits and your tolerance, you want to bet more as the expected value gets higher. And one rule of thumb that I've actually come up with in the more recent years is you never want to bet more than an amount that will negatively psychologically impact you. And I think you, me, all of us as traders, we know that you can get in such a negative feedback loop from some of these losses. And so even if your lockout might be $50,000 or $100,000, if a $20,000 loss is going to ruin your motivation, you're going to be like depressed and upset, well, guess what? You don't want to risk that amount. And so much of progress is being on this positive feedback loop where you're motivated, you're really ready to do work, you're feeling energized. And so if something is really, really, really good, you want to bet approaching that amount that is large, but still won't negatively hurt you.
Two questions. The first is, expected value is going to tell you over time if you're going to make money or lose money. If the expected value is positive, why not bet as much as you can every single time?
Yep. So for starters, because some stuff you start to have variance. So the expected value might be positive, but what if the skew is like super good, but your win rate is only 5%? If you start betting 10% on a 5% win rate trade, you're probably going to blow up. And so a lot of that is recognizing, okay, it's not just about positive expected value, because there's also some opportunity cost. If you're focusing on a trade where you can make 1 penny, is there some trade with an expected value out there of $1? Or if you're going to bet on something that only makes you a penny, but it's highly variant, will some of those downswings, again, affect your psychology? And so it's really trying to allocate your capital in selectively in the right spots with the highest expected value.
So this is one of those things that I was talking about how you tend to play arguments out in the limit. What you pointed out is effectively that even though there might be high expected value, if the risk of that particular trade is a wipeout risk, that means your career will be over, so to speak, then even though the expected value might be high, it might not be worth it if you catch that one time that you lose. So in that sense, that's one limitation that's one example where you would not want to, bet just because the expected value is positive. Are there other examples where you might not want to, other than just psychologically, are there other just tangible reasons?
And probably the most common is just simply opportunity cost. Like even if we talk about buying power or capital, or if the expected value of the play might be very good, but you yourself as a trader, if your decision making is impaired, perhaps you perceive the trade to have positive expected value, but you're really on tilt. Maybe you've lost the last 5 trades and you're yelling and screaming. Well, guess what? Even if it's a good trade, you probably don't want to take it right now. You probably just want to take a break and get in the right mindset. So there are some factors like that, but ultimately it's just, are you able to accurately judge EV and then just bet in a way that's not going to impair your senses and your trading otherwise?
And one of the things from you is a lot of people, I think, will get, 2/3 of the way down thinking this way, and they'll bet, linearly higher amounts. So for example, you'll have 1 unit of expected value, they'll bet 1, 2 units, they'll bet 2, 3 units, they'll bet 3. You don't do that, you bet exponentially. So if you have 1 unit, you might bet 1. If you have 2 units, you might bet 10. And if you have 3, you might bet 50. So how did you come to that way of thinking, and how do you handle that psychologically?
Well, I think a lot is just recognizing the math, and a lot of that I just saw experientially from my trainer. And he was just so innately great at going huge in the best opportunities. And it just paid off again and again and again. And then you would sit there having